Hello, I am John Najarian, and RebelCon 2022 is almost here. We do have a virtual pass. The virtual pass gives you full access to everything, all the streams, the live trading sessions, all of our fabulous keynote speakers. So to learn more about what's going on at RebelCon 2022, whether you're in person or virtual, check out marketrebellion.com/Dallas.
And good afternoon once again, Market Rebels. Happy Thursday, everyone. It was another wild day on Wall Street for sure. If you watched it prior to the open, we had the futures down a little bit. We did get initial jobless claims. It came in a little bit better than expected, but still sold off on the opening bell. But then we got a series of rallies, dips. We rallied around 11 o'clock, 1 o'clock, and 2 o'clock. And just now going into the close, finally got up above yesterday's close. So who would have ever guessed? But it's days like this that I think really show the importance of options and also the power. It's volatility, it's the uncertainty. And those are all things that play right into an options hand. But in order to use them, you have to understand strategies. And so once we started trading tune-up, I did say from time to time we would explore some strategies, and we will do that along with some technical indicators, candlesticks, all kinds of things that will help you to make better decisions. So for today, let's take a look at a calendar spread. And this is a trade that is used quite often in a lot of our services. A lot of traders use calendar spreads. They're one of the more interesting ones because they play more on a mathematical principle as opposed to needing the stock price to move in one direction or another. There are also variations on calendar spreads. We have what could be called double calendars or double diagonals, depending on how you pair them up. But this is just going to be a straight up textbook calendar. So what is a calendar spread? Well, what you're going to do here is you're going to use 2 calls or 2 puts, not one of each. You can't mix them. And you are going to buy a longer dated option and then sell a shorter dated one. And again, for the standard textbook calendar spread, they have to be the same strikes. So for example, let's say that you buy the March 100 call and sell the January 100 call. So notice we are long, let's say if this is January, we're long 3 months and we're short the 1 month option. So we're long the longer dated option, but they have the same strikes. Now, the way these names come about, at least for a lot of the spreads, is for the way that they're laid out on the quote board. So for instance, let's say that we buy the March 100, trading, let's say, for 940, and we sell the Jan for 690. Notice that we are working in this horizontal row, and therefore it's sometimes called a horizontal spread, a calendar spread, because that is what we are separating or differentiating our months of the calendar. It could also be called a time spread, because after all, that's what a calendar does measure. So the horizontal spread, calendar spread, and time spread are 3 different names for the identical strategy. And sometimes that helps traders right off the bat because they'll go, gosh, these sound so confusing. There's really 3 different names for the exact strategy. So regardless of what you call it, if you put this on, it's going to look something like this. It'll look like a little bit of an upside down V. Now, if I were to zoom out a little bit or expand the ranges on these stock prices, look at higher stock prices and lower, you would eventually see these wings flatten out. So don't let this fool you into thinking that it's a short straddle and that you've got unlimited risk. You're going to eventually flatten out because for any kind of a spread, if you buy it, that, or even if you sell it for that matter, as long as it's not a ratio spread, you've got limited risk. There's only so far that this can fall. But notice that in the center here, this red line is our current curve. This is what we look like today. And the black curve is expiration. Now, one of the things that makes a calendar spread a little odd to look at from a risk graph like this is that you're not really at expiration. In a way you are, but in a way you're not. What you're looking at is the expiration of the short-dated option. So in my example, we would be at January expiration. We would have 2 months left on March. And so that's why this black curve doesn't have straight lines. See, most of you have seen the risk graphs when we talk about vertical spreads, calls, puts, things like that, straddles. They all have straight lines at expiration, not on a calendar. And so one of the things that actually makes this, another characteristic that makes it even or interesting, is that these deltas, because they're not straight lines, they're not delta 1. So these break-evens become quite wide. They're usually a lot wider than they appear. So you've got kind of this nice range for the stock price to land and still produce some type of a profit. So as we are waiting for expiration, remember today's curve is the red, we're going to see the center part of that shift up, assuming the stock price stays here at the current price, at the money. And we're going to see these wings start to shift down if the stock price gets out into here. So again, we need that stock price to stay in the center. So this brings up a good question. Why would you trade a calendar? Before I flip the slide here, let me emphasize, I'm going to emphasize it again later. You do not ever trade a calendar just because you think the stock is going to sit still. That's a myth. You hear that a lot. People say the reason for a calendar is because you think the stock is going to sit still. Not true. Not true for any strategy. You always have to have some kind of an edge. And if you can't determine where your edge is or where it's coming from, you shouldn't be trading it. So if you are dealing with grossly mispriced options, if you're buying it too much and selling too little, doesn't matter if the stock in fact does sit still, you are probably going to lose. So you have to remember it's always about finding an edge. So why would you trade it? So it's mostly for pricing discrepancies. This is where our main source of an edge will come from. In future videos, I'll talk about vega or volatility, which is another thing you have to be careful of with the calendar spreads. But for right now, we're just going to talk about pricing discrepancies. And to understand how this works, we have to go back and revisit a topic that we've talked about before in Trading Tune-Up, which is a pricing relationship, sometimes called the square root pricing rule. And what it says is that it takes about 4 times the amount of time to double an option's price. Now, this applies to at-the-money options only. But this also catches traders by surprise. They'll say, well, it seems like if you double the amount of time, it should cost you twice as much money. Seems correct, but it's wrong. Here's the way that it works. Let's say we have a 1-month option trading for $1, and we're trying to estimate what the 4-month option should cost. Well, the way that you figure it out is you notice that we have 4 times the amount of time. And so we take the square root of this number. Square root of 4 is 2. It just means that 2 times 2 is 4. And so now we take this number 2, and that becomes my multiplier over here. That tells me that this second option should be 2 times that of the first. Now, this is according to a pricing model that will be true. In the real world, it will be most of the time mostly true. So if this is a $1 option, you would expect the 4-month option to be trading for about 2. But notice it's not because it has twice as much time, it's because it has 4 times as much time. And that just bumps up the price by a factor of 2. If this 1-month option were trading for $3, 4 months should be trading for about 6. And so once you understand this, it will help you to understand strategies. Now, a little side note, the reason for this strange relationship is because option prices are proportional to volatility, and volatility is proportional to the square root of time. So that's where this is coming from. So let's say that we're on our broker's platform. We see a 1-month option trading for 3, 4-month option trading for 6, kind of what we would expect. No reason in the world to do a calendar spread here, even if you think the stock is going to sit still. There's no edge. This is just flipping a coin. There are better opportunities elsewhere. But what if we saw that this option, the 1 month, was trading for 320? All right, if the 4 month is trading for 6, we would say we could work the problem backwards and say it should be trading for 3, but it's trading for too much. Now we have a potential edge where we could buy the relatively cheap one for 6 and sell the relatively expensive one for 320. Notice I said relatively expensive. Does this really mean that the 320 option is expensive? No, it could mean that the 4 month is cheap. That's the beauty of the calendar spread. We don't even need a pricing model to figure this stuff out. It's all about relative pricing. What else could happen? Well, we're looking at our platform here, and we see that the 4 month is trading for 580. And we look at the 1 month trading for 3. And we say, well, if the 1 month is trading for 3, the 4 months should be trading for 6, but it's relatively cheap. Let's buy the relatively cheap one and sell the relatively expensive one. And that's going to give us an edge. It's not an arbitrage, but it's an edge. And that's what you're looking for. So let's take a look at some of the prices and how they're going to play out. Let's say we've got different days to expiration, different options, maybe 120 days, 90, 60, and 30. Pricing model says that the 120 day is worth 9, 90 days worth 8, 60 is 640, and 450. Now we're going to advance the clock 30 days later. What happens? Well, the 120-day option is now a 90-day option. And so all things being equal, the stock price stays the same, volatility stays the same, everything else stays the same. This 120-day option should be trading for 8 because it's now the 90-day option, and that's what that was trading for back here. So notice that we're just kind of shifting these numbers off on a diagonal. The 90-day option would be a 60-day option, should be trading for 640. And the 60-day option, 30 days later, will be a 30-day option, should be trading for 450. And of course, the 30-day option is expired, would be trading for 0. But do you see how all of these numbers just kind of got shifted off on the diagonal? And that's really what's making this work. So let's say that you bought the 120-day for 9, you sold the 30-day for 450. All right, well, that's a debit of 550. You'd have to pay for it. We've got the same strikes, but we are buying more time. So we know it's a debit spread. And then 30 days later, assuming the stock price is right here at the money, that's going to be worth 8. We could sell that for 8. We could buy this one back for 0, which means we would collect 8. So look at what happened. We spent 550, we sell it for 8. That's a gain of 250. All right, so what happens with a calendar spread is that it will widen. That's the term that we usually use in the markets. It's going to expand if it goes in our favor. It just means it went from 550 to 8. The value got bigger. And the reason it got bigger is that both of these options decayed, but our longer dated option didn't decay as quickly. The shorter dated option fell much faster. And that's what caused this spread to expand. Okay, so that's what's making it work. So let's take a look at another example. Let's put the stock at 100. I'm going to use different numbers this time. Let's say the 100 call is trading for 6 and the shorter dated one is trading for 450. We spend $1.50 at expiration. The 100 call is now 450 and the one that was trading for 450 is now 0. So look what happened. We spent $1.50. It grows to 450. Why? Because the stock moved? Not at all, because time moved. It's about the rates of decay moving at different speeds. Now, where can a calendar spread lose? Let's go back to our initial position, but let's say the stock price climbs up here to 120. So notice that we're below 0. Remember on our graph, this horizontal line at 0 shows 0 profits and losses. So if you're below there, it means you're into losing territory. So we're up here at 120 near expiration. What happens? Well, we paid $1.50. The $100 call that we own is trading for mostly intrinsic value. It's $20. I'm going to call it $20 plus because there'd be a little bit of extrinsic value on it, maybe 10 cents, 20 cents, 50 cents, whatever. If there's a ton of volatility, it might even be $1 or more. but it's basically trading for intrinsic value. What about the short dated option? It's at expiration. It's definitely trading for intrinsic. So if we can sell for 20 and we have to buy back for 20, that's zero. Look what happens. We paid $1.50. We close it for zero. That's a loss. And the reason we lost is because the stock price moved higher. That's one way to lose. What's the other way? Start back here at the beginning. Let's say the stock falls down here to 80. Again, keeping in mind where our zero line is. What happens now? The $100 call goes to zero. Yeah, it might be a little bit of extrinsic value on it. Let's call it 0 plus. The short dated option is definitely expired. It's worth zero, but basically at zero. We paid $1.50. We close it for zero. What happened? The spread narrowed. It collapsed. And the spread will always collapse if the stock price rises too far or if it falls too far. And that's what's going to put you into losing territory. So those are just the basics of what makes a calendar spread tick. I wanted to pass that on and share that with you because, as I always say, that when you change the way that you see options, you'll change the way that you see strategies. And when you change the way that you see strategies, that's when you're going to have confidence and know when to open, when to close, when to hedge, roll, and morph. But you have to understand the basics. So if you want to have a better understanding of how to see strategies, please give this number a call. It's 888-809-8058. You can set up a free one-on-one consultation with one of our world-class coaches. As I've always mentioned, many of these have decades of trading experience on the CBOE or other exchanges. They can pass on a wealth of information to you, even in 30 minutes. So no risk. Can't pass that up for the financial markets. So the number again, 888-809-8058. I hope that helped, and we will see you tomorrow, 4 p.m. at the closing bell for Trading Tune-Up.